Hey everybody, welcome to the Bitwave sponsored Intro to DeFi. Super excited to be doing this. DeFi has obviously been exploding over the last 6-12 months, and so what I want to do is we have a lot of customers using it. We have a lot of customers using it at a very high level where they are just absolutely killing it and on the bleeding edge. And we have a lot of customers who really have absolutely no idea what all this is because they're not actually in that world. And so what we want to do is a really quick webinar that just sort of introduces you to what DeFi is. We'll walk through the basics of how you get a wallet set up, how you transfer some coins into it, how you do some really simple operations on DeFi. I'm going to explain a little bit of the terminology, and then we'll just go. If you have any questions, feel free just to throw them into chat, and I'll answer them as we get into it. So to kind of start out, what the intro, like DeFi itself, it stands for Decentralized Finance, and the way I like to think about it is it's this idea of bringing what would be traditional financial instruments where you'd have to go to a bank or a brokerage or somewhere else to interact with them. It's bringing them into a decentralized peer-to-peer world. And I know that sounds kind of crazy because it is. I mean, that's why DeFi is so exciting. That's why like all these tokens are exploding and the value of all this stuff is going up, is because this idea of disintermediation is always an incredibly powerful tool. And this idea of disintermediating the banks is awesome. And the last few months, in particular, you look at like what happened with Robinhood and GameStop, and essentially what was a industry level attack on retail investors. And it makes you so angry that you're like, we need to find a better way to do this. That kind of thing would not have been possible in DeFi. These tiered levels of access, where some people have better access to liquidity, or some people have better access to markets and some people don't, and you're able to chop those off. Like, that doesn't exist in the DeFi world. DeFi is open to anybody. Anyone can interact with it. Anyone can use it. So that's what's so exciting about it. So just a few terms that you're going to hear me say a lot, and just to kind of like get into it. The first one is tokens. So you can think about this in terms of there's a network out there called Ethereum. Ethereum is a blockchain network. There's another blockchain network out there called Bitcoin. Those both have coins that represent the base currency on that blockchain. So the Bitcoin network obviously has Bitcoin. The Ethereum network has Ethereum. They are the coins that you receive when you do mining work. They're the coins that you pay out when you do fees. What's really cool about Ethereum and a bunch of these other smart contract-based blockchains that are opening up is essentially you can build a smart contract. And a smart contract is just a bit of code that gets deployed to the blockchain and lives there forever until it either self-destructs, or until the end of time, or until the heat death of the universe, whichever one comes first. And so when you can make a contract that essentially defines another token on top of the Ethereum network. So you have your Ethereum, but then you also can have a new token like, USDC is one we'll talk about. Sushi is one that we're going to talk about today. That essentially it both is representatory of a holding of an asset. So holding that token is you holding an asset, and that can basically come along with different rights. So Sushi, for instance, that's one of the main AMMs, the automatic market makers out there. It's one of the DEXs that exists, is this thing called Sushi Swap, and their token is called Sushi. Owning Sushi gives you voting rights for the Sushi Swap DEX, and for new exchanges they open. It gives you voting rights over how they deploy their developer pool, which is part of the fees they pull. And so it's essentially like, you can think of it like stocks, but be very careful with that analogy, because it's like a stock in the sense that you can have the rights to go to like a shareholder meeting and make a vote. It is absolutely nothing like a stock, because it is not giving you ownership in the company. The company itself still exists. So when you buy Sushi or Uni or any of the tokens you're hearing about, AV, like I'm sure you've heard, there's a whole bunch of them that have gone up in value you've heard about. When you buy those, you are not buying a part of that company. You are buying a predetermined set of rights that are based on you holding that, and you're buying a proxy to value. And this is where it gets the squishiest when you're doing the investing on DeFi, is when you a lot of the tokens don't have intrinsic value. People are still buying them and driving the price up. And that's because, it's because people love to gamble. Let's be super honest with ourselves. Like, people love freaking gambling. And so if they could buy something that is kind of seems like a proxy to the company itself, they're going to do it. The plain fact is there is no stock that's like Sushi is sort of pseudo-anonymous. So there is no stock you can go and buy in Sushi Swap. So the closest you can get if you want to invest in Sushi Swap is the Sushi token. And all that's really giving you is some percentage. It's sort of like some percentage of ownership of the developer pool that they have, which is like it's all like a proportion of the fees go into this developer pool that then they can spend to have developers build stuff, and then voting rights on a few other things. So always keep that in mind when you're getting these tokens. Is they have value because you can go and sell them, but at the end of the day, a lot of the value is speculative because it's not like where you own stock in a company. If that company were to go out of business, you would get some money back because you are a partial owner of the things that company owns. That's not how these tokens work. If that token gets hacked, the value of that drops to zero immediately. That's just the way it is. So be very conscious of that when you're getting into this. So a few other things to kind of note here. DEXs are one of the tools that you will be using a lot of. A DEX is a decentralized exchange. So NASDAQ is an exchange. TD Ameritrade is a broker that you use to get to NASDAQ. NASDAQ does market making, like where it's the idea is that the idea with traditional exchanges is it's a maker taker market. So I say, hey, I have 10 GameStop that I want to sell. And I said, I'm going to sell it at, $100. Now I'm going to sell it at $5,000. And so I have that sell order sitting on the books. I had one of those for a while. And someone then comes and says, hey, that's super reasonable. I'm gonna take that other side of it. So you can kind of think of that in a traditional exchange. There's two operations. There is putting your order on the books, and that's either a limit order buy, a limit order sell, and then going and actually taking that order and satisfying it. The reason you don't want to do, there's a couple of different reasons you don't want to do that on the blockchain. One is it's really easy to do front running. Front running happens in the markets as well, and that's one of the things that Robinhood is getting dinged for so badly because they're routing all their traffic to their market maker, and that market maker is actually doing front running attacks against individual retail investors. So that's why individual retail investors get really crappy prices on Robinhood when they do market sales, because essentially you can by front running you can manipulate the price that you're satisfying the actual sale at. And just go and look it up. It's really interesting, but it's called a front running attack. And there's a whole host of these that happen in the crypto markets. So essentially, you don't want to do that because it's really easy to front run attacks. And the other one is that every transaction of the blockchain costs money. So if you break it down to this taker maker, when I post the limit order, costs money for me. It costs money and storage for me to do that on the blockchain. And then when someone satisfies that, it costs money on the blockchain to do that. And so it's a lot more efficient, economically efficient, for us to have just one function that does that. And so this was one of the purest research things that came out of this was out of DeFi in general. There's been a bunch of really cool stuff, but one of the coolest research pieces that's come out of this is this idea of an automatic market maker, what we call an AMM, which is essentially this pool that allows you to do taker maker in one transaction automatically with no one on the other side of it. And it's sort of a price discovery mechanism for tokens. So we'll get into how that all works. It's really, really cool. But I'll use the term DEX a lot, or DEXs. That's just, it's sort of a general term for a distributed exchange or decentralized exchange. And they're usually run by automatic market makers. Examples of that, the biggest one is Uniswap. So go just Google for Uniswap, you can find it. Balancer has one. We're going to be using Sushi Swap today because I'm going to show you the whole thing of how you add liquidity and then how you also go and then stake that liquidity. And more. So staking is this other thing where so getting back to tokens people are trying to build value in tokens in different ways. And they're also trying to incentivize their ecosystems in different ways. So one of the things you'll see, a great example is there's a great example because it makes so much economic sense what they're doing. There's a decentralized index fund out there that specializes in DeFi assets. So they have an index fund that holds it's evenly balanced 12% of each of 8 of these different DeFi tokens. What they do is they want their index fund token to have a price, right? So if I just wanted to own 8 of these tokens, I would just go buy 8 of these tokens. What they're trying to do is they're trying to create a token that is essentially a paired token to the value, just the way an ETF would work. So like the way Spider works on the markets is as the value of these go up, they want the price of the token to go up. And they want to have liquidity pools. They want there to be these decentralized markets for their token. So one of them is called PIP. It's the power index pool token, I think. And so what they do is they want to incentivize people to create and add liquidity to markets where PIP is being exchanged. So what they do is they let you add liquidity, and they let you buy into the token itself. And then if you go and you put liquidity, which is essentially these 50-50 exchanges into Amms, you can then take your token, which represents your ownership of the portion of the liquidity market, and you can stake it to a smart contract, which essentially all it does, it just locks it away where you can still pull it back, but like it kind of just sort of is a way of proving that you own this and you lock it away. And then what they do is they actually reward you for that. So they're going to give you what they call CVP. Sushi does the exact same thing. If you put money if you do liquidity providing for Sushi Swap, you can take the token, which represents your ownership of the liquidity pool, and you can stake it. And then you get this thing called Sushi, which is their token, back as a reward. So staking, or some people call it yield farming, is this idea that it's the second derivative of the DEX itself. So I can put liquidity into a DEX, which I'll make some fees on. And then I can take that and I can stake that token that gives me my liquidity pool token. And now I can actually get staking rewards off of that as well. So you're kind of like figuring out different ways to do it. And there's a lot of different mechanisms around staking. It's a pretty well-known thing. And then finally, the wallets. You've heard a lot about different crypto wallets. Personally, I use a Trezor. It's a hardware wallet, or a ledger. It doesn't really matter. But you really, if you're going to get serious about this, if you're going to have a lot of tokens in this, you want to have a hardware wallet. You have a hardware wallet, you back up the seed key. That is by far the safest way to sort of handle this. Well, what I'm going to show you today is how to use MetaMask. MetaMask lets you use both a wallet that gets stored where the key gets stored on your computer, but also one where you back it by a hardware device. So I'm not going to show you the hardware device part. I'm only going to show you how to do this with a software wallet on your computer, but you can kind of figure that out. I'll leave that as a exercise for the listener. One thing I always talk about whenever I'm doing an intro to crypto in general is the security side of it. So when you set up your wallet, you are going to get what's called a seed phrase. And what it is, it's 12 or 24 words that essentially are the randomness. They're the entropy, the randomness that is your private key in the blockchain world. That is your money. More than anything else in the entire world, your seed phrase is your money. So it is incredibly important that you write it down and that you store it somewhere. Like what you want to do is you want to write it down somewhere. There are these great devices where you can actually use, they are aluminum devices. They're like aluminum stamped out letter sets. So you can basically put these together. You get this aluminum stamped out sheet. You put that in a fire safe vault. That is going to survive, your house burning down or a nuclear bomb or things like that. Because this is your money. That seed phrase, more than anything else, is your money. If someone steals your laptop, as long as you have your seed phrase, you're okay. If your laptop gets wiped, if whatever it is, as long as you have your seed phrase, you're okay. So be very careful of it. One of the really cool things is if you can do this, Trezor has a mechanism where you actually they call it a Shamir shared secret, where you actually can set up you could do a 2 of 3 shared seed words. So you basically get 12 seed words, 12 seed words, 12 seed words. You get a total of 36 seed words. You write them all down individually. You put them in different places around the world. So you put them at your friend's house, your parents' house. You put one of your parents' out, one of your friends' out, one at your house, one at your vacation home. When you need them, as long as you have 2 of the 3, you can essentially recreate your seed. So that's one of the safest ways, because it means if someone breaks into your house and finds one of them, they can't get at your coins. But at the same time, like if one of your houses burns down and you lose it irrecoverably, you still have security on it. So that's just sort of a good thing. So let's talk about AMMs really quick, because AMMs are really, really, really cool. The idea is, I already talked about why you need an AMM on the market, but let me talk a little bit about like how they work, because it is actually really, really clever. The idea is that when you create this smart contract, what you do is you specify a ratio. You specify a ratio of the tokens that it's holding. So for instance, like what Uniswap is always 50-50. Uniswap is a hard set 50-50 ratio. Balancer actually lets you do different ratios. And so it's a good way to get exposure to different tokens if you want, because you can actually have like 80% Bitcoin, 20% Ethereum, and then you can just put all of your money into a liquidity pool, and then you're going to be guaranteed to be holding that, and then you're just getting fees on it. So it's a great way to kind of like it's almost like an index fund balance of the exposure to those assets. But so what happens is that the ratio is 50-50. The first person who interacts with it, who provides liquidity, is going to put tokens in at that ratio. So they're going to put in, so, you know, at 50-50, right now, Bitcoin is 50,000, Ethereum is 2,000. Let's just make it easy. So you would need to put in 25 ETH and 1 Bitcoin, or one, it's called a wrapped Bitcoin on the Ethereum network. We'll talk about like what wrapping is and stuff like that. But the first person would go in and put in, you know, 25 ETH and 1 Bitcoin. If someone wants to exchange that, so that is the liquidity that is in the pool at that time. So if someone wants to exchange that, what they're going to say is like, hey, I have 1 ETH, or let's say I have 1 Bitcoin and I want some ETH for it. So what they can do is they can essentially add a Bitcoin to they put in the Bitcoin on the Bitcoin side, and then they take out the ETH on the other side. Well, that's a really good example, because in that case, essentially what would happen is that you would have to withdraw all of the Bitcoin from all of the ETH from that liquidity pool to satisfy that, because it's at a 50-50 ratio. And so essentially doing that, the act of trading against the AMM changes the price. And that's a term you're going to see all over the place. It's called slippage. And so it's how much, in fact, like that wouldn't happen exactly like that, because they use these curves that define how it sort of works. So you would actually, the price would change as you're taking out the ETH, if that makes sense, as part of that. But essentially you are changing the price as you're doing it. So that's one of the things to watch out for, is in pools, in liquidity pools that have lower liquidity levels, if you're trying to buy $10,000 of something where there's only $10,000 of value in the liquidity pool, you can essentially, it would be like buying out the entire order book on a traditional exchange, which is like something that happens. Like you see when people are making huge trades, you see them buy through the whole order book. And in fact, that's what people were hoping with GameStop. You think about it. What they wanted was the order book to get entirely bought through until they were selling $5,000 GameStop shares. But that can really happen with, it doesn't really happen in traditional markets all that much, because there's so much liquidity and you have these market makers who are playing both sides of the trades. But it can really easily happen in crypto markets, especially low liquidity crypto markets. So that's it. So that's kind of the high level. But then once that changes, so suddenly let's take that example again. Well, now there's 2 Bitcoin in that pool and 0 ETH. And so what's going to happen is that that wants to have a 50-50 split for the price, because right now the price it's 0 ETH for 2 Bitcoin. That is obviously the wrong price. So what happens is arbitrageurs then come in and they start adding in ETH and buying up Bitcoin at the price to then get it back to a reasonable 50-50 split. And the arbitrageurs know the relative value of the coins, so they know that it should be 1 Bitcoin and 25 ETH. So they'll essentially go in and they'll buy up 25 ETH worth of Bitcoin. So they essentially would be the ones to kind of rebalance that pool for you. That's it. Okay, let's get into it. So the first thing that we're going to do is we're going to use MetaMask. MetaMask I would say it's like the most used coin for this, or wallet for this. It's super useful. It can be backed by a hardware wallet, which I really like, but also is like really great interaction with a lot of the different tools. So you come in here, you go download. I'm going to add this as an extension to Chrome. That's like the best way. A lot of people also use Brave. Brave has a built-in, like what Brave did. Brave's another browser that it's a Chrome clone. Like they just forked Chrome, and then they forked MetaMask, and then they mushed them together so that they have a built-in MetaMask inside of their browser. So you can use that also. I prefer Chrome over it, but whatever. I'm adding this to my Chrome, add extension. I'm going to make sure that it gets pinned here. And I'll pin it up here so we can see it. And we'll just walk through this. And your guys, I'm going to show you this here. We'll create a seed phrase here. I'll show you how to write it all down, all of that, do all this. So let's set a password. This is kind of like this is your password to open it. So you can think about this like LastPass. Is you have the password that gives you access to it, which you have to kind of use on a daily basis. And then your seed phrase, which is what's really important, is the thing that you're keeping in the background. So this is my seed phrase. Don't worry, I'm gonna delete this. I don't know if you or I'm not gonna allow you guys to see it. I don't know. We'll figure it out. So I'm adding this to I'm just writing this down because it is always the best practice to write this down. So I'm writing this down in the background here, because they're on the next, what often they do is they ask you then to re-put it in. So you always want to write it down. But this is the thing where you need to save this. You need to make it really safe. What I often use, which I really like, is Crypto Steel. They have these great device. Like, this is what I was talking about, which is essentially it's a punched. Here's one that's actually pretty cool. Also, it's a punched. They give you these punched metal letters that essentially, I think the melting point is like 2,000 degrees Fahrenheit, so way above where your house, like way above where your house would be if it burned down. You put them in this device. What you also do is you can then do either a lock on it, and what I do is I do a lock, and then I also do a piece of security tape, which is one of those. It's those stickers that if you peel it off, it leaves an imprint. So that way I can kind of know if anyone's ever opened it or anything like that. So this is the best way to do it. You can even see, like, they recommend, like, you get your Trezor and then you get your Crypto Steel, and then that's all awesome. Okay, so let me just punch this in. This is by far the most frustrating part of the entire thing, but that's okay. It is very important. And congratulations, we're all set. Okay, great. So now I have this all set up, and they're going to show me I have 0 ETH in here, and I don't have any tokens in here, and that's going to change. Like, we're gonna fix that here pretty quickly. So first, this is my address here. My address is actually a lot longer, but they're showing the first part and the last part. Memorize that. Like, it's one of the really easy hacks against people who use DeFi. So there was this great spearfishing attack, where essentially it was one of the founders of one of the big projects. I think it was Ren, which just makes you super scared because they're also centralized, holding like 120,000 Bitcoin, just nuts. But so what they did is a hacker sent him a spearfishing attack, which, like, he essentially, like, got access to this person's computer, did a custom build of MetaMask, which essentially showed an address, or essentially, like, it showed the address he was expecting, but when he went to send funds, on the back end, it actually replaced it with another address. This is why hardware devices are really important, because the hardware device, what it does is when you do an action on MetaMask, it actually sends it to your hardware device for you to confirm, and the hardware device is going to show you the address that you're sending coins to right there. So even if your MetaMask got hacked, like that guy's did, you would still be safe, because you would see that what you're sending is not what you're actually trying. And that goes for a lot of places. Like, there's a lot of different places where this all kind of connects. So anyways, you click connect. I use Kraken is a great exchange. Any exchange you have, you can do. This is where you're doing your on-ramping and off-ramping. So you do an ACH transfer of money in, then you sell it for Ethereum, and then you have to move it over to your MetaMask. So what I'm going to do is I'm just going to take my Ethereum here, and we're going to move it out. This is probably the second frustrating place, because I need to test MetaMask. I need to check my email to actually do this. I just copy and pasted it straight in from there. But always go and check, because there's these other hacks that people do where they actually watch, like, they'll install software on your computer that actually watches for an Ethereum or Bitcoin address to hit the clipboard. And what they do is they then push their own address on top of it. So essentially, if you're not watching, you would copy an address, and then when you paste it, you would be pasting their address. So you would accidentally be sending it to an attacker. So always just double check, memorize the first 4 of your address. It's very unlikely that they would be able to do, like, you're never going to have it would be very unlikely. It could happen. A really, really sophisticated attack, they could do it, but you're probably not going to be in a situation where, like, the first 4 match. So if you memorize those, you'll be pretty good. So I'm going to save this. This is sending me an email. Let me go to my email. While I'm checking that, any questions at all? Well, my email is going real slow. Oh my God. All right, this is gonna get edited out. All right. Sometimes it can take a little bit of time for Kraken to also send these emails through, but it is coming. I believe. I do believe. All right, there it is. I just got it. So they basically send you an email that says like, hey, confirm that you added this address. This is the best practice, right? You want your exchange. Like, I know I kind of make a joke that this is annoying, and I made a joke about the seed being annoying. Also, it is annoying. Don't get me wrong, but this is what you want. Like, this is good security. This is how we actually handle this. So I just tap on that I'm confirming this. It says it's successful. So then I go back to the withdraw screen here. I hit I should now have it. So I have my test MetaMask here, double check it, ABDA, just like we went through. And I'm just going to move this whole one ETH over there. The problem is that like, it's really expensive right now to do stuff on the blockchain. So if you're getting into this stuff, don't get in with a few $100s because the fees will eat up all of your profits. Like, you have to get in with $10,000, $20,000. I mean, yeah, that sucks. And there's a lot of work being done in Ethereum world, and there's other blockchains that are trying to solve it. But that is kind of what the situation is right now. It can take a few minutes. The way Ethereum works is they produce a new block every 13 minutes. The way that Kraken works is they have a kind of a hot wallet where they'll send a bunch of transactions in one go. So they try to sort through it. So it might take a few minutes. It might, I don't know, I'll keep an eye on it, but pretty soon it'll be there. In the meantime, what I'm going to do is I'm going to go set up my Bitwave really quickly because it can take a few minutes for Bitwave to sync as well. So I'm going to add this wallet to Bitwave. Super easy. Come in here, say create wallet. This is a watch wallet because essentially you'll see this phrase a lot of different places. You're watching another address. Like, Bitwave doesn't control this address. It's just something we're watching. So I'm going to set this up as a watch wallet. I'm just going to call this my test, my MetaMask. Say it was Ethereum, and just drop that in there. And so that's going to start syncing while we're sitting here. And by the time we get to the end of the webinar, and I can show you how we do taxes for DeFi, this is all going to be syncing as part of it. And it should come up with zero balance because the transaction hasn't gone through all the way yet. Okay. Now let's get into the fun part here that we've been waiting for. So what we're going to be doing is we're going to be adding liquidity to Sushi Swap. Sushi Swap's nice because they're one of the few ones that has an active rewards program. What that means is like you put liquidity into Sushi Swap, and then you can go and stake those tokens, and then you start getting sushi on top of it. There's a tool that I love for a lot of this, which is called Zapper. Zapper Fee. I don't know if that's how they pronounce it, or Zapper Fi. I always think of like the Fee-Fi of Zapper Fee. But you'll see this a lot, right? So essentially, this is what's called a DApp, which is a decentralized or distributed app. And the idea is that they do have a server behind this. There is a server back there that's satisfying like requests for prices and token lookups and all that kind of stuff. But the idea is that you don't really have to create an account. Like, this isn't the old world where you go and you sign up for an account, put your email address in and stuff like that. Well, the way you're interacting with this is through the smart contracts and through MetaMask. So you come in here and you say connect MetaMask, and there's a bunch of different things you can connect. And MetaMask also is, if you're using Brave, you would use MetaMask here because it's sort of the same API. What that does is it pops up MetaMask here. And I'm not sure if you can see that, but I got a pop-up that says, connect with MetaMask, Zapper Fee, and then it prompts me to select which address to give them. And this is important because you might have, like, what you really want to do is you want to have a couple different levels of wallets. You want to have like a trading wallet, which is like your hot wallet, where you don't have that backed by a hardware device. And so that's just sort of sitting there and it's on your computer. And if it got hacked, it would suck. It would be a bad day, but it wouldn't, be the end of yourself financially. And then you have another wallet where you keep all of your funds. And you don't necessarily want to give these, because as soon as you hit OK here, this website has access to my address. They can't spend coins, but it's a lot of knowledge, right? Like, if you've been doing a lot of trading, you're sending money around, or if, let's say you get payroll over the blockchain. That's a lot of information that they can pull out. And so what different people do is they'll create a different wallet per DApp that they interact with and they transfer funds over to it. They'll have a hot wallet or a trading wallet, and then they'll have their main backup wallet. Use your own, make your own decisions about that. But there is a privacy concern with giving these guys access to your wallet. I say connect. Boom, we're done, easy peasy. Oh, awesome. Gas is super cheap today. Now, gas should be about 20 Gwei. Gwei is one of the units of Ethereum. I'm almost like I don't know how to describe it, but like the smallest, like the way that cryptocurrencies work, and this might seem absolutely insane, but it's one of these important things from computer sciences. In computer science, floating point, which is a decimal point, is actually really difficult to correctly model, right? So if you've ever heard, like, there are these things called floating point errors. Don't worry too much about it, but at the end of the day, it is really hard to correctly model a decimal point, like a long number with a decimal point. So what cryptocurrencies do is they actually treat everything as if it doesn't have a decimal point, and then they move, and then they basically tell you what the number of decimal points is. So it's like a scientific notation. It's sort of like the opposite of scientific notation. So in scientific notation, I give you like 10.12345, and then give you an E, which is which moves the decimal point that way. In crypto, I give you 1, 2, 3, 4, 5, 6, 7, and then I give you the number of decimal points to move that way. And so that, like, you know, with Ethereum, the smallest unit, which is one, which would be 1 in this kind of way I'm describing it, is called a Wei, WEI, and that was named after I forget who it was named after, but it was named after someone. And so then Gwei is then so Ethereum has 18 decimal places, and so like if you own 1 ETH, you actually own 1 with 18 zeros after it, Wei. I'm explaining this to you because it's really important to understand. Like, you'll see different things called out in different places. And so when you see gas here, gas is it's Gwei, which is like 0.0001 ETH essentially, and it's how much you're gonna be paying for transaction fees. And it's super important. Like, this is a really important thing for you to understand and do it. Okay, so this is Zapper, and look, looks like I've got my money has come through. You can see kind of your holdings here. That's really nice. You can come into an exchange, and you can actually, they do routing across exchanges. The reason I'm going to show you Zapper really quickly is we're going to be going into Sushi Swap. But the problem is, I think I explained this to you, is that when you provide liquidity to a liquidity pool, what you are essentially doing is you are providing in the ratio that the liquidity pool is asking for. And so in my case, I only have ETH, right? So I only have ETH. So that now creates an issue that if I want to put into a liquidity pool that is, let's say, an ETH WBTC liquidity pool, I need to have WBTC. So that would mean that I would either need to go buy the appropriate amount of wrapped BTC, or I can use something like Zapper, which what they do is they actually have a smart contract which does sort of this gas optimized transaction, which is that I give them ETH, they exchange half the ETH for WBTC, and then they put both of that into the liquidity pool. But that's what you have to always remember: when you're providing liquidity, you are essentially having to go through that process of, like, you have to have the proportions that the liquidity pool is asking. Cool. Okay, so now that we've gotten here, let me explain the two things you're going to see really quickly, which is WETH and WBTC. You're going to see this all over the place, and it's kind of complicated. But if you remember back to what I was saying, so you have those blockchains, and the blockchains have coins, right? So Bitcoin is the base coin for the Bitcoin network. ETH is the base coin for the Ethereum network, and then tokens are on top of it. Tokens in general on Ethereum are defined using something called ERC20. It doesn't matter what that is, but essentially, like, almost every token is ERC20 compliant. And that's what makes these automatic market makers work, because anyone who makes a token can then, as long as the token matches the correct interface that this market make, that this tooling, that this smart contract is expecting, then anyone can go and create an instance of the smart contract for one of these automatic market makers with their token. So it essentially it's like this, that's why decentralized is so cool. It's like you build it once and you define like an interface and suddenly you get all this free stuff on top of it. The problem is Bitcoin is a totally separate network, and Ethereum itself does not line up with that ERC20 interface. And so in order to actually trade, it's almost the deep irony of this, in order to actually trade ETH on these automatic market makers, on one of these dexes, you have to do something called wrapping. And what that does is it basically takes your ETH and it turns it into a token that then has the interface that these tools are expecting. When we do the treatment for this in Bitwave, we actually treat it as one-to-one. We don't treat it as a separate token. We don't do that with Wrapped Bitcoin because Wrapped Bitcoin has a counterparty risk. The way Wrapped Bitcoin works is that you are sending your Bitcoin to someone and they're holding on to it and then they're generating this Wrapped Bitcoin token because these are on separate networks. So when you pick up a counterparty risk, you are essentially, you from an accounting perspective and tax perspective, you don't want to treat that as the same token because if they got hacked, I'll tell you what, WBTC is not going to be worth what Bitcoin is. With WETH, it's different because there's actually just a really simple smart contract that's been heavily audited that does that wrapping. So there really is no counterparty risk. Like when you wrap ETH, there is almost no risk that that's going to go somewhere. It is super easy. Okay, so let's start with the first part of this, which is I'm just going to trade some of my ETH for some wrapped Bitcoin. I'm just going to use the CoinGecko list here. Pick one of the top lists that they recommend. What you're doing here is it's kind of what I said that's hard about this is that like anyone can go and make one of these AMMs, right? So if someone was being nefarious is they can create a token that has a symbol WBTC. They make a really pretty website and they say, hey, buy WBTC from here. They take you to a Sushi swap pool that is for their WBTC, but their WBTC has no value. So you're going to give them $40,000. They're going to give you back a token that has no value. So the reason you do this because this is the list this is the canonical list. You're picking who you trust to map the contract address. Don't worry about it to the symbol or like to the canonical symbol for it. So I'm just going to use this one. And what we're going to do just wrap BTC, WBTC, because I like it. And I'm going to do just under, we'll do a quarter of an Ethereum as opposed to a full half, but you could basically do up to like half of your stake here. So I'll just do 0.25, 0.25 ETH is going to give me 0.009 wrap BTC. And you can see like, what we're just saying. So it's right now the price on Sushi Swap is 27 ETH per 1 BTC because ETH is about $1,800. BTC is at 48,800 this morning. My price impact with the slippage, what we're talking about, is super low because this is an enormous pool with tons of liquidity. Let's actually go look at this right now. So let's go look at how much liquidity there is here. So here's the WBTC ETH pair that I'm going to be. This is the liquidity pool that I'm going to be trading against, and then I'm going to then add my liquidity to. So right now there is $1 billion in here. Jesus, that's crazy. There's $1 billion of Ethereum and WETH in here. Absolutely nuts. So there's 10,000 Bitcoin in this pool and 270 ETH. And so we're going to be, when we trade, we make no impact to the price because of how large those numbers are. There's a lot of other liquidity pools that are much smaller, and those are ones that you would actually see a higher price slippage. So I hit swap, I hit confirm. Can you guys see my MetaMask? All right, let me share my full screen here because I want you to see the full MetaMask for this because it's exciting, I guess. I don't know if exciting is the right word. All right, hold on one sec. Okay, so what's happening here is it's asking me to confirm this, that I'm going to swap 0.25 ETH for this much WBTC. Fees are expensive right now. This is what I'm talking about. Like, you can make this up in profits, but not if you're doing this at the level, like at this level. If you're doing this like 1 ETH, it's just you're like literally this is going to eat the profits for the next, because the way these liquidity pools work is that when you trade, they also are taking a very small fee. The normal fee is 0.3%. which is lower than a lot of other places. But that's how you incentivize liquidity providers, is essentially people provide liquidity and they get rewarded in fees. And so so when you provide it, you are actually making money off of the trades that are happening when you provide liquidity to a pool. And so you could make that, but you're not going to make $34 worth of fees in the next 10 years from providing this little liquidity. But I hit confirm and it's all done. It will sit there. We'll kind of watch on the blockchain. You can open up this here and see, click on activity, and you can see this is pending. The thing that everyone in the world uses is Etherscan. So get used to Etherscan because it's a great product. This is showing you what's happening. Boom, my transaction just got confirmed. So now I can come in here and I will show you. So it shows me here that it got confirmed. And now if I open up my MetaMask, you'll see that I have 0.75 ETH. And if I want, I can go, this is how you sort of track your other assets, is I click add token, type in WBTC here, wrapped BTC is what we're talking about, hit next, shows I have 0.9 in here and we are all set. So now I can both track my ETH in here as well as the wrapped BTC. There's one thing that you probably didn't see, which is that as part of that contract interaction, it actually did the wrapping for ETH to WETH. So it actually wrapped the contract itself. The first thing it did is it wrapped it. And you can actually, if you ever are interested in the underlying things here, you can kind of watch it here, is that it wrapped it. That's what this part is here, is it's getting back 0.25 WETH. And then it did the exchange against the liquidity pool for that. Great. Okay, so now let's go provide this as liquidity. This is the next exciting thing. So I'm going to go to the pair here, which we were just looking at. And I can you click this thing that says like add liquidity. In different dexes have this in different places. In Uniswap, it says pool. In Balancer, there's like a pools button you go and click here that's under pairs on the side here and all that kind of stuff. So I'm going to do my max here, and it figures it out for me essentially. So it's gonna calculate it for me. And it's telling me I don't have enough WETH because I don't have any WETH at all. So what we can do is we'll just go and we'll do a quick swap here of the ETH to WETH. I'll let you do that here. Uniswap lets you do that, so I'll just use Uniswap for it. So we can show you Uniswap also. Uniswap. So use Uniswap. This is their app, the exact same thing as Sushi that we've been looking at. All good here. And they actually have a nice thing where they just give you a nice interface to wrap it. I like it because you don't want to just Google for this stuff. Like you don't want to just Google for wrapping ETH, because there are different attacks. Like crypto it's a dangerous world out there, and there are different attacks to basically against you. And so one of them is like people will create fake websites and they'll do a bunch of SEO optimization so that if you search for wrap Ethereum, maybe a bad website pops up top. It's one of those things that can happen. So same thing, you've seen me do this 100 times now. I'm just going to wrap 0.5 of the ETH, hit wrap here. It should be, this is a relatively cheap. I mean, when gas is at 100 Gwei, this is expensive. When gas is at 20 Gwei, this is a lot cheaper. And then once the Ethereum sharding comes into play in the next year, like 6 months to a year, whatever it is, that you'll see these prices go down quite a bit. That's why it's good to be doing this now, but you need to be doing this now in large enough volume that you are, because there's a lot of upside. As soon as the price, as soon as Ethereum solves a lot of their scaling issues, a lot of the price of this stuff is going to kind of go up, because there's a barrier to entry here. I mean, honestly, if I'm telling you that you need to have $10,000 to do this, not everyone has $10,000 that they're willing to lose just playing around with. And that sucks, but that's sort of the table stakes. At some point that will change when the price goes way down, and then you'll see a lot more people getting involved. And then once you see retail uptake, these things should get a lot more expensive, or the value should go up in a lot of these. Okay, now I have my WETH, we're all set. I go back to a Sushi swap, and I'm going to add my liquidity. So we were just let's do the one we were just looking at here. So this is the WBTC ETH pair. I now have enough to do this. So it's going to ask me for a few things. There's a notion of the way that tokens work on the blockchain is that in order for anyone else to interact with them, you have to kind of approve that interaction. And so that's what I'm doing here is I need to approve that Sushi Swap can interact with my tokens. And it's just going to be for this amount. It'll be purely for 0.9 WBTC and 0.25. Actually, let me do that. Yeah. All right. Now it just, I don't know. This is one of those things that if you have OCD and it bothers you when you see slightly not rounded numbers, you're just gonna have to get used to it. Because at the end of the day, like you never get rounded numbers in this stuff, and I feel like it just drives me nuts. But whatever. So I'm gonna approve the WBTC. Again, this is what, like, you see, like, we've now spent this. I think that's like $50 worth of gas we've now spent, and I'm gonna approve my WETH. So both those transactions are floating out there. Should hit pretty quickly. You can kind of watch them here. What it does is it queues them. So the way Ethereum works is that you really can only execute one transaction. You can. It's not exactly like this, but really you execute transactions because each one has a nonce that is like the transaction ID and from your wallet, and it's like a monotonically increasing nonce. And so they'll do these things where they basically set this up and then kick this out and then kick this one out. MetaMask has a great feature where if for some reason, like, gas prices can change a lot over the course of a day. So let's say you get something all teed up to execute, and then when you go and you actually fire it, the gas has changed. It can be slow here. So, one of the tricks is you can actually click to speed it up if you want, and then what it lets you do is just add a little bit more money to it, and you're it's a great feature. They'll do a for how long it takes you to confirm. Oh my gosh, 7 minutes. What are you doing, man? So okay, let's maybe we speed this up. Because no one got that kind of time in their life. All right, so while I'm waiting for this, there's a great question that came in, which was to explain a little bit about the gas. And I think it's a great question because it is not at all obvious. If you are not super technical on it, it's not obvious. So essentially, when you are spending gas, or the way Ethereum works, is that you pay to interact with the blockchain. And what you're doing is you're paying for two things. You're paying for computation power on every single node that is running in the entire world supporting Ethereum. So essentially, like, let's say you could create a smart contract that just added 5 + 5, right? Smart contracts can be that simple. They don't need to be complicated. Essentially, in order to interact with that smart contract, every single computer that backs up the Ethereum blockchain has to add 5 + 5. So if you think about it, like, that's it's actually like an incredibly expensive operation, because essentially what all of these guys are doing is they're all making sure that they are approving a consensus for your interaction with the blockchain. So they're essentially saying that every single one of them has to make sure that what you are trying to do is valid on the blockchain. Not just one of them can do it; they all have to do it. Now, only one of them gets credit for it. Only one of them gets the mining reward for that particular block. But they all have to do the same math, because that's how these consensus-driven things work. And so if you think about that, like, you're paying for the computation power. You're also paying for the storage. So when you think about like a contract like this, where I'm adding liquidity, or when I did that swap, there's the way these smart contracts work is that they're actually on the smart contract on the blockchain. They keep a list that says this address owns 10 Bitcoin. This address owns 15 Bitcoin. So that's actually stored on every single node every single Ethereum node in the entire world is storing that. So again, like, that's expensive. And there's a lot of optimizations to have around there. So your gas fee is based on, when you look at this gas fee, it's based on those two things. So the more that you're storing, or the more computation power that's happening, the more expensive an operation will be. So that's why, like, what you'll notice is, like, the WETH wrapping was one of the cheapest ones, because WETH wrapping is just, it's nearly free. I mean, it's a very, very cheap operation. It's, I don't know, like, it's maybe 15 lines of code on the blockchain. Whereas liquidity adding is super complicated because it's interacting with a bunch of different contracts, it's doing all this different stuff. So you'll notice like, and you can kind of anticipate it. Like the more complicated you kind of think something will be, the more it's going to cost you in gas. So the AMMs are all super optimized for that really simple swap transaction. They're all heavily optimized for that. So that's going to be one of the cheapest interactions you can do with these things. But they don't particularly optimize these types of things, which is like adding liquidity and whatnot. So yeah, this is just me. This is like Vegas. I'm just throwing money around here because for fees so we can get through this and before we're all done. But we saw the WBTC one successfully got incorporated, and now it's waiting for that. Good UIs, they basically are reactive, so they watch for this happening and they actually tell you when it's all done. If it's not working, you can hit refresh here. And the idea of these dApps is that they are looking at the blockchain like in real time. So hitting refresh, you might lose your place, but you're never going to like lose a transaction or anything like that. So now we're done. So I hit supply, and this is me adding now adding BTC to this liquidity pool. This is going to be expensive, just to warn you. And this is also why I left a lot of extra ETH in there on top of it. So this is a $45 operation. That this is the price you pay for, I guess, greatness or whatever. So let's see. So this will take a little bit of time to approve. Hopefully it'll be relatively quick. If I'm curious, I'll pop up an Etherscan here just to see. I'll make sure that it was so they think that this is going to go through quick. Then we're fine there. Okay, so then the last thing I'm going to show is basically what you've heard about, which is like yield farming or staking. So now that I've done this, Sushi is incentivizing people to interact with their protocol. So they are excited about people interacting with their protocol. So Sushi is actually going to, they've set up a way to reward me for this. So I'm going to come in here and click on farm. And let me close this stuff to the right. Okay, and I have that WBTC peer. They give it a cutesy name here, which is their Bitcoin. I don't know. I've never really gotten Sushi, but I guess it's cute. And so what they're going to do here is they're going to show staking, and here's what their return. So right now, staking is giving you 24% yearly APY. There are a lot of other ones that are a lot better than this. And part of it is that there's $1 billion in here, so they're not really rewarding state. Like Sushi has no incentive to, like, they don't really care if more people put money into that. What you'll notice is you actually could come in here and you can look at farm. If I get rid of the filter, you can actually sort by ROI and see like this one is they're doing a much higher liquidity on this. And so one of the things I talked about at the beginning of this was like, what value do these tokens have? Like the Sushi token's a great example. So they're rewarding you in Sushi tokens, and you have to ask yourself like what value it has. It gives you no rights over the company. These things are deployed to smart contracts. Where you do have value is that it was a Sushi bet. It was a protocol level bet vote for what are the actual yields and who gets boosted and all these different things. So essentially, like, there is value in these things because you can make, there's like right now there's $7 million in this liquidity pool. Getting this boosted by Sushi can probably got the liquidity in this up from like $2 million, $6 million. We'll get it up to $20 million. I mean, that's like, so there are intrinsic values based on the voting rights and things like that, but it's not the same as a company. Like just always keep that in mind. It's not the same as a company. Okay, so let's go back. So I'm going to, so first so the way that this worked behind the scenes, and here's where it gets here's where you get in the nitty gritty, but it's important for you to understand. When I provided liquidity to the pool, so I gave them 1 ETH and 1 Bitcoin or whatever it was. When I provide that liquidity, they actually gave me back a token, which is my representation of my ownership stake in that pool. So I can take that token, give it back to the pool, and they'll give me back my BTC and my ETH. Or I can take that token, and you can see the value of that token. So if we go and we look at this transaction on the blockchain, so let's go look at the liquidity providing the transaction Etherscan. You should learn how to read these. So wrapped. So it moved wrapped BTC. So here you can kind of see exactly what was happening is I put in 0.009 wrapped BTC, 0.24 wrapped ETH. This is my address, my ABDA that we all memorized. So this is me moving from my address to the Sushi Swap WBTC contract, these two amounts. And this is them giving me, they minted, that's what they call it. They minted some tokens. They gave some of them to me, and then they put some of them in a developer liquidity pool. So this is my ownership token. They call this a liquidity pool token. This is my ownership token for the rights to withdraw at the moment that this happened, this amount of BTC from this pool. And I can even go in and I can actually add this token to Etherscan if I want, and I can even send this token to people. Like I could send it if I made a bet with someone and they wanted to get paid out in and they want to get paid out in tokens, I could just send them this token, and then I lose all my rights to this liquidity pool, and they gain it. And so you can come in here and see that I have, sure nerf that up. I can see that I have 0.000020 liquidity in this pool. These all have 18 decimal points, so they can go to that, to that level. Okie dokie, where was I? So, okay, now I'm going to approve the staking, so what this does is this is the same thing. Remember I had to approve my WEEF, which gave the Sushi Swap contract access to it. I had to approve my BTC, which gave the Sushi Swap contract to it. And now I have to approve that liquidity pool token. And that's going to give the Sushi Swap contract access to it when I go and actually stake it. So I'm just going to confirm this. Hopefully this will be a relatively quick one. We'll see. It's pretty good at sort of, once gas prices change, it's pretty good about picking those up. So come in here. It says 1 minute. Okay, that should be fine. It should pick it up relatively quickly. This is more art than science. At the end of the day, everyone in the world is using. There's this thing called the Mempool, which is like you execute a transaction like we just did. When you do that, what they do is it transmit it up to the blockchain to all the nodes. The nodes hold it in their memory until they mine a block, and essentially whoever mines the block picks which transactions to put it into. To put into that block. And so the way they pick usually is by looking at the fees. So they include the highest fee transactions in the block because they're, as the miner, that's where they make their money. They get 2 ETH per block they mine, plus all of the fees from that block. And so that's like, they're incentivized to wait for high fees to come through and all of that. So hopefully this is happening pretty soon. Might have to speed it up. Okay, so see how like you can watch it, it kind of like went down. So obviously like I did this at a time when it was like popping, like there was something going on and it was going to pop the other way, or like gas prices fluctuate, so that happens. So just click speed up again. I'll pick fastest. Oh, it's painful. It's a lot of money. A lot of money we're throwing around here. Well, we're waiting for this. Any other questions? All right. So cool, that came through. Great question. So the question was, how is APY determined? And that is an excellent question. So if you look at this, what they're telling you is this is the amount of sushi that is getting generated per day, essentially. And what they do to calculate APY is they basically take this, multiply it by the number of days in the year, so times 365, and then they basically divide that by the current prices of the two coins. So right now, sushi is about $14. WEEF is 1,800. WBTC is 48,000. So the division between those two gives you essentially like a percentage of your return on investment versus the coins by themselves, if that makes sense. It's a little bit squishy. Like I almost wish they didn't use, but like everyone knows the APY term. It's not really a totally accurate term for this, but that is how they calculate it. It's the value of it versus all of it. Okay, so here we go. I'm going to stake it. This is super exciting. So I'm going to stake the max amount that I can, hit confirm. This will ask me to interact here. Again, another super expensive. So never do what I'm doing here because we've now eaten up so much that any profits we could ever possibly hope to get from this, we have completely like munched up. It is gone. But that is the way things, that's the way things go. I can write it off as a business expense. It is all good. If you use Bitwave, you can very easily write it off as a business expense. Okay, great. So this went through, and now we can see. So here's where this gets super cool: is that this is now I'm now earning liquidity. I'm earning coins on this immediately. Every single block, I earn a little bit of sushi based on this deposit. So super exciting. That's really great. I'm already earning it. And here's where Zapper's pretty nice, is because Zapper, what's cool is like, you know, it because this is all interaction with smart contracts on the thing, and this is also why you have to be really careful with your addresses. Because Zapper has the same address of what I've been doing over Sushi Swap, is they then get immediate visibility for all of that kind of stuff. So you can see that I have, you know, this amount staked. Here's how it all looks. I have almost none of the pool and all of this, almost none of the pool, and that's what's going on there. And then you can see on my wallet. And what will happen relatively soon, it should be showing up here, is I should almost immediately, let's see here. Yeah, so I've already made 0.0000200875 sushi on this. And at any point you can go and claim it. So you can go into Sushi Swap and actually call your rewards essentially. Or you can do it from Zapper. Or if you add more liquidity, or if you stake more tokens, they'll actually pay out your rewards at that point. And if you withdraw your staking, you'll get all of your rewards at that point also. So there's fewer ways to actually take it back. And the way we do treatment of that is that's essentially revenue. I mean, it is, you could think of it as like interest on a loan, kind of, a little bit in a squishy way, but it is essentially revenue that you're getting. So when you go and you deal with that in Bitwave, you actually are just taking it as revenue. So that's it. So another great question is if I have a cheat sheet. I don't. I live on this every single day, so that's how I kind of memorize it. But what I'll do is on the slides that we send out, we're gonna basically all include a page that has a few of the different things that I like. But the ones to remember: MetaMask is your best friend for the wallet. Zapper is a great way to get in and out of these liquidity pools without kind of doing it, and a great way just to kind of monitor your investments. Like, let's see how our investments are doing, guys. We started with we started with just over 1 Ethereum, which is about $1,800, and we're down $300. So this is the crypto way. We could all get behind. But yeah, there's Sushi Swap is one of the big ones. Uniswap. A great place to look is DeFi Pulse. DeFi Pulse is an aggregator of a bunch of these different projects. So you can go here and just sort of keep an eye on the different things. They also have some ways of looking at like APY and things like that. But yeah, these are three other ones. Like Maker is a great. They are not. We didn't talk about this at all. But as opposed to a DEX, Maker is actually a completely on blockchain loaning thing. Loaning thing, is that right? No, lending market. There we go. So you essentially provide collateral. So let's say you own Bitcoin and you don't want to spend your Bitcoin. Bitcoin's appreciating way better than dollar. So you put your collateral up as Bitcoin, and then you can borrow USDC against it. And at any point, if the value of your Bitcoin goes down enough that you are under collateralized, someone will come in and actually liquidate parts of your loan and claw back the money to get you to the correct collateralization levels. We'll do a whole nother webinar about that. But essentially, it's another place where you can be one of the people who provides liquidity. So, you think about it, like I put up WBTC and I get USDC, someone needs to provide that USDC and then you get a return on that. So Maker and Aave and Compound are actually all lending markets. So, all right, so that's that's the sort of the end of the intro to DeFi. What I'm gonna do is really quickly is I'll show you this on how we sort of do the treatment of this in Bitcoin. In Bitwave, and walk through it and show you how to actually track your taxes on these things, what we're doing. So if you remember, the interesting part about the market maker, and this is really interesting. I get interesting. I can't even bear word interesting, because essentially you still own that BTC and that WETH that's in that market maker. And then there's trades happening against it at all times, but you still own rights to that. And so there's different ways that people do treatment of this for taxes. One way is they essentially treat this thing where I give you the WETH and the WBTC and you give me back a token. You can treat that as a trade. Now it sucks to treat it like that because you essentially are doing a full real, like it ends up being a taxable event if you treat it like a trade. So essentially when you treat it like a trade, you're saying, hey, I'm disposing of my WETH, I'm disposing of my WBTC, and I'm acquiring this new asset there. And that's okay, but a lot of people own, Ethereum from when it was $5, and they don't necessarily want to take the hit on that. And so then what they would do is they actually want to track their assets as though they were still holding them themselves, and then just recognize the individual small trades that are happening. So Bitwave lets you do that. It's we have a whole mechanism to let you do that. All right, so everything is now hooked up in Bitwave. Everything's been synced in. So I'm gonna go ahead and show you. It's a little bit later. I moved some funds around. I moved it out of that hot wallet into a Trezor that we have, so you can actually look at it. But I want to kind of show you how we actually do the accounting for that. So it's actually pretty easy. That's the whole point of Bitwave, is to make it incredibly easy to manage the cryptocurrency at your company. So I'll show you kind of all the different transactions that we went through over the course of the lesson here. So first of all, we transferred in 1 ETH. Before I started recording, I actually transferred in 1 ETH. What we're going to do is we're going to mark this as revenue. Now, if this was not revenue, if this was me transferring between my wallets that we were pretending to control, we would actually be able to recognize that as an internal transfer. And that's what something like this that you see right here is me transferring from a MetaMask to that Trezor ETH, and we automatically detect it as a transfer. That's what this little squiggly line means and all that kind of stuff. What I'm going to do is I'm going to categorize this as just revenue. So this is just sales revenue. And we'll say this is from some mining customer. We automatically tease out an exchange rate here. That comes from we have a really powerful pricing engine that goes through a bunch of different sources to figure out what the price would be. We can do these paths between different pairs, and it's pretty cool how that all works. So this is going to go into QuickBooks as a receipt, as a revenue receipt. It's really, really easy. You can then see here some of the trades I made. So getting ready for the demo, I put together a trade for ETH for WBTC, and then ETH for WETH, which is wrapping. And you can actually see that we're automatically picking up the fees on all of these. And then here was just some contract interactions. Where it starts to get really interesting is this is the first place it gets interesting. So this is me depositing to a liquidity pool. This was the very, very first deposit to that liquidity pool. So you can see that I paid a fee of 0.02 ETH. I put in 0.009 WBTC and 0.24 WETH. And in return, I got that 0.000002 token for that pool. So when I go to categorize that, I can actually say that this was a staking categorization. We automatically detect that this was interacting with Sushi. Any pool that you use on Sushi will automatically detect that. That goes for Uniswap, Balancer, you go down the list and name it. We'll automatically detect it. So in this case, you can see what we staked, which is this 0.009 WBTC, this 0.24 WETH. Now the important thing is I also need to grab a hold of my current total staked. What this does is it says, I didn't really show this as part of the demo, but you can keep staking to the same pool. So you can stake a little bit here and then stake a little bit here. That's really cool. Second is once you stake, you're actually if you think about these the way an Ethereum block works is you have 50, 100 transactions, and they're all in a row. And your transaction is one of those 50 or 100. But what happens is they get executed on the blockchain sequentially. So the first one happens, and the second one, and the third one, down the line. So in fact, from the time that you put your coinage in, so from the time that I put in 0.009 WBTC and 0.249 WETH, a bunch of trades could happen against that pool in the rest of that block, which could actually change my ownership of that pool within that very block. So if I've staked some coins, by the end of my staking within that block, I already could have made some, we call these virtual trades. Yeah, they're real trades. They're saying I've staked some of these coins, I've added liquidity to this pool, someone else is then doing the trading against it, and I'm taking the fees and I'm taking the value for that. And so that's why we have to grab it here, but then when we unstake it, you also have to grab it there. So I'll mark this as a Ethereum network here, nice and easy. And here we can show, so this is the actual staking transaction. This is where I staked it to the Sushi onsen to make my staking. Here's where I unstaked it. And then here is where I actually removed my liquidity. And you can see my liquidity is different. right? So I started at not 0.00923, and now I'm at 0.000933. So essentially the price of WBTC versus WETH, even in that short time, what was that? That was over the course of, that's very, very little time. Over the course of that day, that was about 24 hours before I unstaked it all. Over the course of that day, that's how much the liquidity changed. So I'm going to go do the exact same categorization here. I mark it as total. I load my total staked assets. This will say 0 now because I've now removed all of my liquidity from there. Hit the Ethereum network there. Hit save, and now you're done. When you go and run your taxes, we are automatically going to detect your trades. We do not treat it as a disposition. So we do not treat this particular transaction as a disposition of WBTC and WETH. And then we do treat this as we don't treat this as an acquisition of those or disposition of this. All you do is you're going to see a trade which represents the new value that you have earned off of this. So you're going to see a trade for 0.0092 or 1 WBTC for a little bit of Ethereum. And that's it. It's that easy to do all your tracking, and you can do other stuff. You can always, this is just a normal expense. We let you do categorization for expenses in here. So this lets you say that this is an expense against the Ethereum network. We support splits and pretty much everything you can imagine that you would want to be able to do as part of a bookkeeping exercise. You can execute from inside of Bitwave and then just run your taxes. And we have this whole tie-out method for how we actually run taxes at the end of the period. At the end of the month, we help you run your taxes, run a balance report, and then we create a number that essentially should match up with what you have in your accounting system with what we have in ours. And all of this gets pushed into your accounting system. So the fee from this will actually get pushed into your accounting system directly from Bitwave here. So that's it. Thank you so much.